This year, one of the key factors when it comes to housing is interest rates and how high interest rates have become. This year, we reached a 23-year high with interest rates hovering over 8%. But things are changing. And interest rates over the past 10 days have plummeted, which is a great thing for housing. It's a great thing for homeowners as well. But the question we get asked is, when interest rates start to go down, when is a good time to refinance? As an example, this year, if you locked into a 7.5% or 7.75 or an 8% interest rate, when will it make sense for me to refinance that as rates tick down? And how do I know rates aren't going to go lower? Let's answer those two questions. Number one, when should I refinance? The best way to explain when you should refinance is when you can look at a 2.5-year break-even point. That is about the mark to say it's worth it to refinance. Now you may say, I'm going to be in my house for 20 years or whatever the case is, but the reality is you look at about a 2.5-year break-even from your costs. And when that threshold of savings is greater, then that's when you know to pull the trigger. Let me give you an example. So let's say that it costs you $5,000 to refinance your home, because every refinance costs money. Now, some of you that bought this year, your lender may be offering a free refinance, by the way, so check with your originating lender first. But most cases they won't. So let's say it costs you $5,000 to refinance your home. And by refinancing your residence, you're gonna save, say, $100 a month, okay? In that $100 a month, it would take you 50 months in order to break even from your costs. So in that scenario, when you look at what the real balance is of that 2.5-year threshold, it's probably not worth it to quite refi yet, saving only $100 when it costs you $5,000. Now let's say though, you're at an 8% interest rate and you can refinance to 6.5%, and your loan amount is $500,000, a 1.5 off $500,000. So let's say that savings becomes $600 a month. Well, if it costs you only $5,000 to save $600 a month, that one becomes a no-brainer. So what you always need to measure is the cost basis of the refinance worth it for the amount of savings that I'm gonna save, and how long is that break-even point? That's all you have to measure to say, is it worth refinancing? But the question becomes, I don't wanna do this again, because I don't wanna pay those costs again. So what we ask ourselves is, how do I measure the market? How do I know that if I refinance in December of 2023, that I'm not gonna refinance, that rates aren't gonna go down, so I gotta refinance again in April of 2024? And the answer to that question is, no one really knows, okay? But as we can see rates starting to tick back down and that the Fed has kind of put a halt right now on interest rate hikes, I think it's safe to assume that interest rates are going to tick down for a little while. Now, where that bottom is, no one knows, and it's not worth guessing. My best advice is to look at that formula. Look and see the cost versus the break even on the monthly. Also keep in mind, when they roll in your new loan, they can roll it into the purchase, they can roll it into the refi amount, so you don't have to come out of pocket with any of these monies. It'll simply get added onto your principal. As an example, if it's $5,000 to refinance your home and you owe $500,000, your new balance will be $505,000. You'll also skip that first month's payment, which also is a good relief mechanism. If your payment's $3,000 a month, you won't have that payment next month. It won't be till the following month. So there's a lot of advantages to refinancing because of that month skipped in payment, and they just roll it into the loan, plus the new savings that you'll have. So even if you refinance and you save and you go from an 8% to a 7%, and then rates go to 6%, it's probably worth refinancing that again. So instead of guessing and holding out and saying, I think they're gonna go lower, and then all of a sudden rates jump back up again when you could have had an opportunity to strike, don't be greedy. Because ultimately, you're going to save money. It's a matter of not trying to time the market perfectly. It's just simply a matter of ask yourself the question. Whatever position you're in, whether you just refinanced or this is your first time refinancing, just ask yourself the simple question. What is the cost to refi versus what my payment's going to be, and what is the break even in months for that to be worth it or not. I can tell you that rates are ticking down, and from those homeowners that bought this year, you may be, and even towards the end of last year, you're probably going to be in a position to refinance your home within the next 3 to 6 months here, and possibly even sooner. So pay attention to the market, and also double check with your lender that did your original loan, because there was a lot of programs out there that were for those that bought a home over the past 18 months or so, to where if you do refinance your home with them, they are offering a no-cost refinance. So just do your homework and see if that's available. And if you like this information, like and subscribe. We'll talk to you soon.